Okay, good evening, everybody. Sorry about the slight delay. We had technical communication issues. My name is Charles Enoch, and I'm the ESC Fellow at St. Antony's College at the University of Oxford. And welcome to this seminar, which is organized by the European Political Economy Project at the European Studies Centre in Oxford. This term, we're following two themes. We've 6 seminars on the political economy of climate change and 2 on the workings of the institutions managing the economic and financial systems of Europe and beyond. Today, therefore, we're focusing on the second theme, looking at the proposed standard on transparency for central banks that's been developed by the International Monetary Fund. We live at a time where there's skepticism amongst much of the population that technocrats and institutions run by technocrats, particularly when such institutions have been amassing more influence in people's lives. As Paul Tucker described in his book, Unelected Power, central banks are among such institutions. One way to mitigate the concerns about technocrats is to make them accountable and to create daylight over what they're doing. Transparency over their powers, their policies, and how they make their decisions thus becomes important. And assessing the degree of transparency of a central bank is achieved by having a transparency standard. That's the subject of tonight's discussion. We have 3 excellent speakers to take us through this. The bios of the 3 speakers were circulated with the materials for this seminar, so I will be brief. Ghiath Shabsigh, an assistant director in the Monetary and Capital Markets Department of the IMF, with responsibilities including fintech, central banking, and financial sector development. He was the head of the team that has developed the transparency standard. Ghiath has a long and wide experience at the IMF and has worked on monetary and financial issues in all regions of the world. He will speak for about 20 minutes. We then have 2 discussants who will comment largely on the relevance of the code to Europe. Daniel Hardy is an academic visitor here at the European Studies Centre. He too has spent the bulk of his career at the IMF and has worked also at the Bundesbank and the Austrian Capital Markets Authority. He has also worked on monetary and financial issues in many countries, latterly most heavily in Europe, conducting the most recent financial sector assessment program for the Euro area. And our second discussant is Johannes Lindner, head of the Institutions and Forum Division of the European Central Bank, which coordinates the ECB's relations with other EU institutions, and particularly the Council and the European Parliament. He's worked in several policy areas in the ECB, including as advisor in the area of market infrastructure and payments. Daniel and Johannes will each speak for about 10 minutes. We should then have about 40 minutes for questions and answers. So please submit your questions by using the Q&A function at the bottom of your screen. And unless you've indicated that you prefer that I ask the question, or unless similar questions are bundled together, I will then call on Julie Adams, who's behind the screen, to unmute you so you can ask your question yourself. The presentations are being recorded, but we will then switch off the recording as we begin the Q&A. As with all our seminars, we'll post the podcast of the seminar, as well as a blog on the ESC webpage in the coming week. And so I turn to Ghiath to tell us about the transparency standard for central banks.
Thank you very much, Charles, and welcome everyone. I would like, before I start, to thank the European Studies Centre and Charles for inviting me to meet with all of you. This is a great opportunity for us, and I would like also to welcome my dear colleagues Daniel and Johannes to join me in this discussion, which is very relevant, as Charles noted. Let me have a few slides here to share with you. If you allow me, Charles, I will share the slides with the audience. All right. I hope my slides are showing and nothing else on my screens.
Yeah,
fine.
All right.
It's fine.
Very good. Thank you very much. So, as Charles noted, central banks are really entering a new era after the global financial crisis. This was ushered in because of multiple factors that changed how central banks operate within the economies and what central banks' mandates are. The result of the global financial crisis for central banking is really very stark. On one hand, it led to unprecedented expansion of central banks' economic footprint. This is what Charles alluded to in his introduction. Um, Central banks were called upon to provide financial support for markets, for the economies, for all sorts of things, using very unconventional instruments to do so. That led to significant expansion of their economic footprint. I will give examples in the next slide. But the other factor is that central banks' mandate have been expanded considerably. Whereas before the crisis, most central banks focused solely on ensuring financial stability, using monetary instruments, and so on. Then after the crisis, and continuing now, financial stability mandates, various sorts of financial stability mandates were added to the central banks. Not only this, but also quite often new unusual mandates like consumer protection. Some central banks have taken that on themselves. Anti-money laundering supervision, some central banks have taken on their own board. But also some central banks who were not micro supervisors suddenly became prudential supervisors. So the new mandate have expanded considerably for many central banks. So the expanded footprint and expanded mandate have created anxiety really in the societies, in many societies. And we start hearing more and more calls for greater accountability, how the resources of the central bank are used, what is the impact of that use of the resources on the economy, on the society. There are equity issues that need to be considered here. There are economic issues that need to be considered here. So there are greater calls for accountability. We start hearing this all over the world, particularly in advanced economies. But also, not surprisingly, more and more we are seeing more and more pressures on central banks' autonomy. Whereas central banks prior to the global financial crisis occupied a part of the economy. Now their expansion have put them under the microscope, and more pressures from many politicians are put on central banks' autonomy, including in some advanced economies. Now, that of course called for enhanced transparency, and many central banks have tried to do that after the global financial crisis, expanding the set of issues that they are communicating to the public, enhancing their transparency practices. Now, the COVID crisis now simply reinforced that trend. It's even accelerating that trend. The central banks last year have taken even more measures. They expanded their footprint. They even expanded their mandates, the scope of their mandates. Now, all of these issues are really leading to two important issues when it comes to transparency. One, the old paradigm about the norms that underpin the pre-GFC transparency principles are no longer valid. They have been altered fundamentally, and they are not adequate anymore. Now, that calls for a new transparency framework, and that is where the momentum at the IMF to move ahead with the new transparency code for central bank. Prior to the new code, we had what we call monetary policy transparency code, which focus only on policies. But that is obviously predate the GFC and what the GFC has changed. So let me show you a couple of examples about the impact of the central banks. Let's look at the central bank's balance sheet in percent of GDP. Just a simple measure to give you the scope of their economic footprint. As you can see, starting in the global financial crisis, there was a large uptick in the size of the major central banks around the world: US, ECB, Japan, UK, and Switzerland. And that trend really did not let down. I mean, it continued to rise over time. And when the COVID hit last year, we have another uptick. So we see now central bank balance sheet, like in Japan, in the US and in Japan, well above 100% of GDP. In many other countries, reaching well above the 50% of GDP. These are enormous economic footprint. And that's not only related to the major central banks, but also many European central banks outside the euro have experienced similar uptick, increase in the size of their balance sheet in percent of GDP. These are important factors because it shows the impact of the central banks on the economies, on their economies. But let's look also at the mandates. We are using here the central bank legislation database, the 2017. The 2021 is being updated now, so it's not ready. So we looked at central banks mandates from that database. And that database, by the way, is available to everybody, to all academics, to the public. Anybody can access it, and you can Google it, and you can find it. So we see like a majority of central banks continue to have the price stability, 127 central banks. But then we see now more and more central banks having financial stability, macroprudential mandate, 80 of, also a majority of them. But also quite a number of central banks have microprudential financial stability mandate and other mandates, including consumer protection and anti-money laundering supervision. So these are simple facts that illustrate the expansion of the central bank's economic footprint and mandate in the society. Now, that called on a new design. So we spend a lot of time looking at the experiences of the central bank over the past, since the global financial crisis, because really many central banks have tried to enhance their transparency, and they have struggled with that. So these struggles basically were the design consideration that we have to have in mind when designing a new central bank transparency code. Of course, it has to reflect the transparency lessons that are learned from the GFC and its aftermath. But also it has to incorporate the changes in monetary policy practices, including the use of unconventional monetary policies that we've seen over and over, including last year because of the COVID crisis. Importantly also, it has to incorporate the expansion of central bank balance sheet. This is something actually little noticed in the transparency circles, but as central bank balance sheet expanded, people start noticing how impactful these balance sheet and the composition of these balance sheet on the economic life. So that has to be incorporated in any new design. So it has to take into account, of course, the broadening of central bank mandate, functions, and powers, including financial stability. The rise of non-traditional objectives also should be included. The focus of the way we see transparency, it is not an objective by itself. It has to serve another objective. The objective is to focus is on policy effectiveness, really. It's focused on facilitating the implementation of the policy objectives and to address macroeconomic risks rather than simply disclosing operational process. So the transparency should become an instrument to improve policy effectiveness. It should allow also central bank to map their transparency choices. There is no one model that fits all. There are a number of possibilities, and central banks should be able to map their choices there. And the reason for that, to support an informed discussion with their stakeholders. And the needs of these stakeholders differ across countries. Importantly, central bank have legitimate need for confidentiality. So how do we balance this enhanced transparency, the call for enhanced transparency, with a legitimate need for confidentiality? That's an important consideration for the design of the new central bank transparency code. Now, once that code is done, when we do assessment, that assessment has to meet a number of objectives. It has to be outcome focused, not only on process. It has really to see the outcome of the actions of the central bank, how transparency affect the outcome of central banks, and how central banks are transparent about them. It has to be modular because not all issues related to transparency are relevant to all central banks. So the central banks must be able to navigate the different options that they have. It has to be risk-based. Basically, how is it relevant to the macroeconomic situation? How is it relevant to the stakeholders of the country? It has to be proportional in the sense that what is needed for an advanced, sophisticated financial market is probably different from what is needed for a simple economy. Now, it is very important, and this is something that it is easily to confuse. The central bank transparency code should not be a governance framework. It should not be a policy framework. In other words, it should not give views on the governance of central bank. It should not give views on the adequacy of the policies of the central banks. It should solely and fully focus on the transparency of the governance arrangement and policy frameworks. So you may have a situation where you have a bad governance practice in the central bank, but they are very transparent about it. The Ministry of Finance basically called the shot, and the central bank website says the Ministry of Finance called the shot. From a transparency point of view, they get a high mark, even though from a governance point of view, that may be a questionable arrangement. Now, central bank operate a very diverse circumstance and environment. So the new design has really to accommodate all environments where central banks operate. Basically, it should be applicable to all central banks. Now, it is important from our perspective to note the CBT is a voluntary code. It is not a mandatory code for central bank. We encourage central banks to adopt the code. But also, it is not part of the IMF surveillance unless it is requested by the authorities themselves. So these are the design considerations that we had in mind. And based on these considerations, we developed a 5 pillars framework, transparency framework. The transparency framework should prove pillar 1. It focuses on the transparency in governance arrangements. So this is the institutional part of the code. Apologies. And then pillar 2 focuses on transparency in policies. Whatever the policy is, could be monetary policy, could be macroprudential policy, could be FX policies, all policies. Then pillar 3, it is a transparency in the instruments that are used to implement the policy. So this is the transparency in operation, how these policies are implemented. In pillar 5, it's a transparency, okay, what's the outcome of these policies and these operations? So this is a transparency in outcome. And finally, we reserve a full pillar on the transparency of official relationship. Now that pillar could be easily subsumed on all the other pillars, but we kept it separate because of the importance of this relationship from a central banking point of view. So when we look at pillar 1, we look at the legal structures. We look at the mandate, objective, functions, and powers. We look at the autonomy arrangements, institutional autonomy, functional, personal autonomy, and financial autonomy. And we use autonomy here and independence interchangeably, by the way. Then we look at decision-making arrangements within the central bank. We look at risk management practices. This is becoming extremely important in a situation where central banks are exposed to a rising risk, financial and otherwise, because of expanded economic footprint and mandates. We look at their internal accountability. We look at communication. This is also very important. Central banks has to be transparent about how they communicate, who they communicate to, and who is communicating. Finally, we have a component of transparency of governance that is related to confidentiality. Now, it is very difficult to set the confidentiality level for every principle, but because they differ across different policies and they differ across different countries. So the central bank has to be clear about its confidentiality policy, what it considers confidential, why it considers confidential. And that is part of transparency in governance. In policies, we look at frameworks, policy decision, but also importantly, what are the supporting analyses? So there should be transparency on what led to these decisions. Operations, what are the instruments, the coverage, who has access to these instruments? Outcome, these are ex post reports on governance actions, on policies, and on operations. Now, when we look at pillar 5, there are 3 components there. Official relationship, what is the relationship between the central bank and the government? Agencies, services, consultation arrangement, financing, everything. Other agency here include financial service authorities, deposit insurance, any other agency that the central banks interact with on a regular basis. And then also transparency in the central bank international relations, including with the IMF, with other countries, other central banks. Now, let me give you, so if you, I would encourage you to go to our website at the IMF, and you will find the code there, and you can download it. It's publicly posted. And it has two parts. The first part is part A, lists the principles. It goes over all the modules that we discussed in the previous slide. So I have an example here on monetary policy. You see principle 2.1 stating what is the transparency principle for monetary policy. And it focuses, as we said, on objective framework, instrument, and monetary policy. And then beneath that, you see the subsets, the description of the subset of principles. But then in part B, we are expanding that. Now, this is where we are catching the diversity of practices across the globe, the diversity of needs. So we provided three areas of practices, what we call core practices, where we think all central banks, irrespective of their condition, should meet. And then we have expanded, which provide additional criteria on top of core, and then comprehensive on top of that. Now, it is very critical to note that these are not ratings. So it is not like compliant, non-compliant, or partially compliant. And they are not ranking in the sense that expanded is better than core and comprehensive is better than expanded, because these are really determined by the circumstances of the countries. We can see easily countries where they don't need to be expanded. They are small central banks, and core is more than sufficient for them. So they cannot be pushed to go to expanded and comprehensive, because that is expensive and unnecessary, frankly speaking, for the objective of transparency. And that is very critical. Now, let me quickly look what we mean by disclosures from our perspective. Public disclosures is very critical component for transparency, obviously, but it is broad. It includes nearly any form of publication. And the target is the general public. It could, that includes the central bank's own staff, any parliaments, government, other agencies, institutions, other markets, and the general public, not limited to consumers, deposit holders, and investors. The way how you communicate to different sections could be different, but the transparency policy should cover all of these, the general public at large. Dimensions of transparency, it includes how the central banks disclose information. The means of transparency could be website, could be official gazettes, and so on. It has to be relevant to the time of the disclosure. The timeliness, which depend on the specific objective of transparency, and periodicity. So they may be disclosing adequately in timely, but not sufficient periodicity. And that also depends on the frequency of actions and relevance to stakeholders. Finally, quality of disclosure. Central bank may disclose, for example, its legal framework, saying that we are autonomous, but that could be buried into 500-page law, and that is put in second layer of central bank website. Is that accessible? Well, you know, if you are a lawyer really looking for that information, yes, but not for the general public. So the quality of disclosure is very important. So from our perspective, what are the next steps? And this is my last slide. So this code has gone through very extensive consultation during 2020, late 2019 and 2020. We reached out to all central banks, and we had an external advisory board composed of eminent scholars and ex-central bankers who advised us also on the process. The code was approved unanimously by our board in July 2022. And it has been received very well by central banks so far. So right now we are in a pilot phase until next year's, and we are assessing, reviewing. We don't use the word assessment because there are no ranking or rating here. We use the word reviews. So we are reviewing 7 central banks, from advanced to emerging to low-income countries, across all continents to provide us a rich experience of how the central bank could operate and will perform in different environments. So far, the response has been very positive. Central banks have contacted us. Beyond the 7 central banks that we are doing ourselves, many central banks called on us and told us that they are doing their own self-reviews and starting adjusting their transparency practices in light of the new code. Once we finish the pilot phase, we'll reevaluate the code in late 2022. Obviously, we will see if there are any additional changes that need to be done in light of the experience we had so far. Now, we established a CBT portal, which also would be accessible to everybody shortly. And that portal will house all the CBT reviews that we do. And central banks also will have the option to post their own internal reviews for the public. And that will become very important knowledge sharing arrangement among central banks and for the public in general, for all those who are interested. My colleague Ashraf Khan, who was my co-author on the CBT, is also joining us, and he is the key holder, the master for the CBT portal. And Charles, I stop here, and that's the end of my presentation. Thank you very much. You are on mute, Charles.
Good spot. Thanks very much. That was very interesting. Yes, should we move straight on then to the first discussion? Just to remind people, if you have questions, please put them on the Q&A, and we'll get to them after the second discussion. On to you, Daniel.
Yes, thanks, and thanks to Ghiath for that excellent presentation. Just cut to the quick of what's important in this code. One thing, by the way, is very striking from the presentation, but also reading the IMF paper, is just sort of wide range of activities on which central banks are now expected to communicate, from traditional ones such as monetary policy and payment systems oversight, now to macroprudential policy, and perhaps even to things like green transition and financial inclusion. And this variety is what justifies the modular construction of the central bank transparency code. For any one central bank, many, but certainly not all components will be relevant, and the degree of relevance will vary from central bank to central bank. So the code is also very usefully organized on these 5 pillars. As mentioned, governance, policies, operations, outcomes, and official relations. But I risk adding to the complexity by suggesting maybe you should look across these pillars in order to understand the effects of transparency on the one hand, and the incentives of being transparent on the other, where these incentives may differ for different players and over time also. One of the points that I want to emphasize, and which kind of subtext to the central bank transparency code, that there are multiple players involved in achieving and maintaining central bank transparency. So some mechanisms for transparency operate ex ante. These elements, most in pillars 1, 2, part of 3, and 5, include the legal assignment of decision-making responsibilities and powers and formal reporting requirements. These fundamentals are set largely by the legislature on the proposal of the government, not the central bank's decision. Those fundamentals are translated into practical arrangements, certainly by the central bank itself at most operational level, but also in part by the Ministry of Finance, for example, and the supervisory agencies with their separate entities and work together. Also, ex ante is a policy framework for the various areas of central bank operations, such as monetary and exchange rate policy and supporting analysis. And here's where transparency has a wide effect on the economy as a whole, namely through its effects on expectations. Insofar as greater transparency translates into reduced ambiguity, reduced uncertainty about central bank reaction function, how it will behave in different circumstances, policy effectiveness may be increased. An obvious example is where a central bank has a firm, well-defined inflation target commitment. Also, what's called forward guidance nowadays helps to make the path of inflation more credible and even self-fulfilling. And this has become increasingly seen as very desirable, as opposed to tradition of more opportunistic or so-called constructive ambiguity. That's again something I'll come back to it later. I'd also like to point out already, the central bank Transparency Code does not demand a precise policy stance or even ranking of priorities. One can be transparently, shall we say, non-quantitative about the weight given to inflation versus output and employment, about the exchange rate intervention rule, about emergency liquidity assistance decisions where the central bank provides funding to a bank in difficulties. One can even be transparent in a non-specific way about the non-specificities in governance arrangements, say, where decisions are taken jointly with several institutions. You need to say, these are the rules not actually assign precise weights to different people's opinions. Some mechanisms for transparency operate contemporaneously, and these most come up in Pillar 3. And typically, these are explanations for how a decision is made in the context of a given policy framework. So you say, we have this general framework, today we set the interest rate at X. And the challenge is that when decisions are most needed to be explained is probably in crisis situations. But then it's most difficult to be transparent because there's not enough time to prepare often, because information is market sensitive. Some people need to make a decision, and it's very sensitive what you say, don't say, you just need to do it. You can't provide much analysis to make it transparent. Again, I think the code accommodates this possibility. These are also the times when momentous decisions have to be made rather quickly and based on rather sketchy information, and what may prove exposed to errors are quite likely to occur. The possibility of embarrassment or worse is acute, a point which I shall return. Then there are mechanisms for transparency to operate ex post, such as requirements to report to the legislature or the public. These are mostly in Pillar 4, or 5 partly, and where accounts have to be audited and so on. Here again, and the issue is how statutory requirements are translated to practice. Ex post transparency can have a major impact also on decisions because they're anticipated. And anticipation revelation will influence how decisions are made. If you know the truth will out, you know that your sins will sooner or later be discovered and result in loss of reputation or position. Hence, you're more likely to remain virtuous. In this way, ex post transparency increases ex ante policy credibility. But again, ex post transparency does not just depend upon law and the central bank actions. The legislature, media, commentators need to challenge and probe the explanations provided by the central bank. Otherwise, it's quite easy for the central bank to meet the letter of the code, but not the spirit. In assessing observance or reviewing observance of the code, one needs to look at the practice of the central bank and also those of others. In some areas, like international communications on Pillar 5, plays an important role, where central banks are eager to be respected by their peers in international bodies, such as the standard setters and maybe also the IMF. Indeed, the domestic audience may be more prone to being in awe of the central bank, prestigious, and expertise, and so on, and therefore actually be rather bad demanding true transparency from it. You may recall Alan Greenspan's famous words to the US Congress, if I seem unduly clear to you, you must have misunderstood what I said. So he was not, no one could really question Alan Greenspan about this, and if you want to stonewall, you get away with it. Which leads me to another point. Why is transparency not always desired? I mean, transparency in the abstract seems like motherhood and apple pie. I mean, who wants to be non-transparent or admit to being non-transparent? Who's in favor of being opaque and obscure and lurking in the shadows? Not put in the abstract, like, why is this a problem? But it turns out, if you think about it a bit, transparency can generate a number of material, political, and economic costs, not only to the central bank, but I think in many cases actually to others, including the government. And hereby they should distinguish between, there's something we want to keep confidential, like private information, personal information, so on. The transparency goes beyond that. You may want to keep certain aspects of your decision-making policy obscure. I mean, one is that communication is time-consuming and effortful. It takes a lot of effort to produce good information on a regular basis. And if you're a small central bank in a country, you just don't have the resources to devote that many resources spare to devote to being transparent and keeping all possible audiences well informed. Second is the possibility of embarrassment. And embarrassment matters because if you're strictly embarrassed, your procedure is reduced, your autonomy is reduced, and ultimately you can also be dismissed for doing things, or you have to be obliged. Now, embarrassment, I think there may be different forms. One is, for example, central banks don't like to reveal, or nobody likes to reveal, when they're actually rather ignorant. So when sometimes decisions are based upon rather little analysis, and that's of course not something you want to show off to people. I sometimes thought in my career that one of the secrets of central banking is that they actually don't have that many secrets. You want to have this or mystique a bit about you, and then the reading that you just guessed is not good for you. Second, it's embarrassing when you commit errors, or what actually are ex post errors. Perhaps ex ante they weren't errors, but ex post they look bad. Sometimes central banks be embarrassed by things that are actually correct things to do, but certainly don't sell well to the public. And for example, sometimes necessary for central bank to pay certain of their staff very high salaries in order to attract expertise, which looks bad. And looks bad to the rest of government, looks bad to the public, but that's a going rate for people to do, I don't know, cybersecurity or something. You have to pay it, but it still looks embarrassing. And the fourth area, perhaps most importantly, is where too much transparency can somehow harm the reputation you're trying to construct of being objective and public interest and so on. I mean, it's revealed that there are deep divisions in the board of the central bank, or if certain board members are persistently voting along party lines. This is embarrassing. These people are meant to be objective servants of the state, and it looks really bad they disagree or behaving. It seems just rather narrow interest. And this goes in further form of cost of transparency with actually malfeasance involved, where, for example, the cases where the central bank may be engaged in bribery. Central banks, you can imagine, are not keen on revealing these cases, and their staff do this. It does happen. And it was more serious is when the central bank is unduly obsequious towards government of some special interest. Where somehow the government has pressured central bank to do something in their interests, or some economic group has done this, is embarrassing to reveal. And lastly, this loss of constructive ambiguity, which I'll elaborate a bit about. Now, again, constructive ambiguity has gone out of fashion a bit. They now look for forward guidance, but it can have its uses in moderation. Ghiath mentioned some of those. And for example, we're talking about providing emergency liquidity to a central bank. You can't tell exactly rules in advance, partly because the situation is complicated, and partly because you create moral hazard. Likewise, with exchange rate regimes, you can't have a one-way bet. You can't say you're going to do it, provide people with a certain way to speculate against you. And then also they make it even times when you want to be able to engineer an inflation surprise. So you break your own policy about inflation in order to deal with some severe economic shock. And I did do some research here, and I came across, for example, a working paper from 1997, Transparency and Ambiguity in Central Bank Safety and Operations, authored by Charles Enoch, Peter Stella, and May Hamis. I also have a nice quote from no less than Ben Bernanke, writing in 2020. The Fed should also consider maintaining constructive ambiguity about the future use of negative short-term rates. So Ben Bernanke sees some use in it. One can also formalize this, by the way, in thinking about a persuasion game, where the central bank has some information advantage, but it's not omniscient. And so there's an advantage to release good news, but be rather coy about bad news. And this works because the market can't tell whether you're being obscuring the facts or you just don't know. And one kind of sees this happening in central banks. You tend to be more transparent about good news and bad news. And there's also some formal evidence about this in studies of central bank communications. I'm saying that this may be actually no bad thing, and second, it may be unavoidable. And the central bank transparency code does actually accommodate these possibilities, but rather hidden in this message, the transparency is not necessarily or always incentive compatible. You may have good intentions, but in a difficult situation, the temptation to obscure the truth may be irresistible. This is just the way life is. And furthermore, everybody knows that central bank will be prone to this temptation and downgrade its credibility accordingly. So if we value transparency, we want to contain this temptation, at least, not totally eliminate it. Two mechanisms seem to come to mind. And the first, to establish a long-standing culture of transparency, both in the central bank and in the central bank watchers. In that way, the central bank will have a reputation for transparency to protect, but even in bad times, it will not give it up so easily. And the second is that the central bank will tend to be caught out with trying to obfuscate. The second mechanism is to embed the central bank in a system of institutions that promote such communication and transparency, at least in some perimeter, perhaps not globally, but in some perimeter. And for European banks, that remit encompasses not only the national and global counterparts, but also some European counterparts, such as the European supervisory authorities. And for the monetary union members, of course, there's the European system of central banks, the single supervisory mechanism, and the single resolution board. And thus, I've used up my time and arrived at a good point to hand over to Johannes.
Thank you very much, Daniel. There's again further things, and maybe Ghiath at the end wants to come back on it, but let's go through the other discussants and some of the questions as well, and then leave time for Ghiath at the end. Okay, Johannes, over to you. Thank you.
Very good. I hope you can see my slides. No, this is a really nice transition. Thank you very much, Daniel, because I think what I can add here is really sort of the practitioner's perspective from someone that has been involved in accountability relations of the ECB now for many, many years, and in a way kind of shed some light about the interplay between accountability and transparency. But I would like to first thank you, Charles, and also Daniel for inviting me as a discussant. I mean, I've looked a bit around what the European Political Economy series has provided. I had been following some of the issues earlier, and I really say you really have a very nice seminar series, a very nice project here. I mean, back in my old days when I was a student in Nuffield, we often went to St. Antony's for the parties. And in that respect, it's a shame that all this is taking place virtually, but I hope there will be a time when we catch up in person after the pandemic. So let me quickly start with something that in a way nicely combines the IMF and the ECB, which is two quotes from Ms. Lagarde, if I may, because I think it nicely sums up what the sort of main points I want to make in my short discussion. What as managing director, Madame Lagarde said was that transparency, and this was in a press conference when she was asked on central bank transparency, when she said, transparency is a tool, and you need to see transparency in its interaction with accountability and with communication. And then when she became central bank president, I think she nicely put transparency in the broader framework of accountability. And I think what you see here with these 3 points that I've been quoting here, it is the interplay between sort of accountability and the institutional setup that a central bank has, and the tasks and mandate that they have. Secondly, transparency as the cornerstone of accountability relations. And then thirdly, the sort of relevance of trust, but also the sort of evolutionary nature of what central banks are doing, and that accountability together with transparency is the way of in a way explaining better the information that you've provided. So that's a bit the gist of what I wanted to say. And let me zoom in now a bit more into the main points. Now, first of all, and I wanted to congratulate the IMF for this very important work. And I think transparency has been put at the policy agenda here very prominently. And we, as Eurosystem and also as the ECB, have tried to contribute to that endeavor. I mean, there was very active engagement from ECB staff with the IMF staff during the preparation. We also coordinated within the Eurosystem the feedback in the context of the IMF survey on the code, and also in terms of feedback to the IMF executive board discussion in the concluding meeting. So very good initiative, and we've tried from our side to contribute to making this a success. Now, one of the key messages, and I think Ghiath has really nicely put this, is that the central bank code is something that is a benchmark or is a tool for all central banks, but you have to take into account the institutional setup of each individual central bank. So in that respect, I think it's important, sorry, I'm just going one up again. It's important to recognize the idiosyncratic nature of the euro system. So we are in a currency union that is a sort of decentralized currency union, where you have the ECB and the 19 national central banks in a way forming the euro system. And there are certain tasks that are euro system tasks that are done centrally or decided upon centrally, but implemented decentrally. And there are certain tasks that national central banks still have that are not Eurosystem tasks. These are tasks that central banks do in their responsibility as national central banks. And equally, the setup of the highest decision-making body at the ECB also represents, in a way, this nature of a system. So you have the 5 executive board members, the president, and then 19 governing council members that are there ex officio as representatives of the national central banks, but ad personam, so they are due to decide in the interest of the euro system or the euro area as a whole. Then on the institutional setup, the independence, but also much of the framework, the institutional framework, is really laid down in an international treaty. So it's not easy to change, and it's very much protected with a strong emphasis on independence, which also sets to a certain extent of the frame then for transparency and accountability. And lastly, as I mentioned, certain tasks, the key tasks are done centrally, decided upon centrally, and it's only natural that these central tasks are then also, the accountability for that is done at the European level to the representatives of the European citizens, and that's the European Parliament. So the main accountability relationship is by the ECB to the European Parliament. Now, if you zoom in a bit more on this accountability relations with the European Parliament, I think what is very important is that despite the sort of treaty not being able to change quickly, it provides for flexibility that recognizes that also the tasks that a central bank and that we central banks and here at the ECB have exercised may evolve over time, and that equally also the transparency and accountability framework needs to be evolving over time. And you can see that here at the ECB, we go clearly beyond what is laid down in the treaty. And since the great financial crisis, really in terms of frequency, in terms of format, in terms of focus, accountability relations have really sharpened further. I mean, just one example I put in here, if you really look how much in the last legislative term, in the 8th term, the written replies to MEP letters has really shot up. So you really see that's as one example of where further interaction has been intensified. And if you look at it, has been further intensified now with the pandemic. Normally, there are 7 interactions between the president or the vice president or other board members and the parliament, mainly the Econ committee. Now, since the pandemic, there have been 13 interactions in a period of 13 months. So you see also with the pandemic, there's been another kind of intensification of accountability relations that we've seen. And what are the drivers? I've already hinted at that already. Here, I mean, economic developments, I mean, the ECB's role in the crisis, the adaptation of unconventional monetary policy measures, and I'm sort of echoing a bit what Ghiath has said more generally for central banks. Also institutional change. I mean, the ECB was given, or the Eurosystem was given the task of micro supervision. The single supervisory mechanism was created. And also there are new frontiers. So digital currency, climate change are new, new requests that are in a way out there, where there are expectation that central banks are addressing these challenges. And if you look at the second graph I have here, which is in fact the first, what you see, what is interesting is the evolution since the establishment of the ECB, and the blue line is who has heard about the ECB. and you now have over 85% that have heard about the ECB. So the ECB is much more known, but also equally, the people that have no view on whether they trust or not trust the ECB has also gone down from 30 to 13%. So people know of the ECB, but they also have a view on the ECB. So in that respect, of course, that sets a frame for what they expect in terms of transparency, in terms of communication, and in particular in terms of accountability. Now, let me go to my last slide, which tries to really sort of zoom in a little bit more on this general theme that I think Ghiath has highlighted, and that is part of the transparency code, namely that transparency is a tool that increases effectiveness also for accountability. So I want to zoom in a little bit on this interplay between accountability further on accountability and transparency. And we have seen examples on where the accountability relationship between, in particular, the European Parliament has led to more transparency. So there's been from citizens, from lobby groups, calls for more transparency on our corporate sector purchasing programs. And then MEPs, 41 MEPs wrote a letter saying you need to have more transparency, more data on the CSPP. And that led then to an increase in transparency. And then, in a way, that increase of transparency has also led to further, I would even say, better accountability. So we're getting now much sharper and zoomed in questions on, for example, the CSPP and climate change, the impact that our corporate sector purchasing program has on climate change. Or another example, we've now started to publish since 2016. We've started to publish how are we, in fact, implementing the suggestions that the European Parliament has adopted as part of their resolution to our annual report. So then on many, many pages, you go through all the requests and suggestions that the resolution entails, and you explain how you implement it, or you also correspond on calls for more transparency in more detail. Now, a final point, which also I think was nicely pointed out here by Ghiath, is this, and Daniel also, I think, nicely kind of described this balancing between confidentiality and transparency. And I want to give kind of two examples, which one we could pick up further in the discussion. One is non-public hearings. I mean, I've not talked much about the supervisory accountability structure, which has a separate accountability framework to the monetary policy one. But in the supervisory accountability framework, we do have non-public hearings. So there is a possibility to explain to members of the European Parliament in more detail in a non-public setup. So that's a way of being transparent, but not to the public, but to the MEPs. So it sort of tries to balance, for market sensitivity and other reasons, to balance in a way transparency and confidentiality requirements. Another example on which I want to conclude was the decision in 15 to publish the anonymized monetary policy accounts of the ECB, a big decision, but it was decided to do it anonymized. And I think that was also to take into account the specific setup we are in as a decentralized currency union. You did not want an individual governing council member, that is a president of a national central bank, to be put under pressure from a national constituency to, in a way, take the perspective of the economic needs of his or her economy, his or her country, but to say, look, it's better. We're not fully transparent. We leave out the names of the individuals. We keep the arguments, because we then can maybe better preserve the focus of all members of the governing council onto the euro area economy. And with this, I would stop.
Okay.
I'll stop sharing my screen now.
Right. Okay. Thank you, Johannes. So I think we've had really three very interesting and comprehensive presentations. Again, I encourage people to press the Q&A, and we should have time for them. Can I abuse my position as chair to actually